Ladies and gentlemen, good day and welcome to the Q1 FY26 earnings conference call for Updater Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinion, and expectation of the company as on date of this call. These statements are not the guarantee of future performance and involve risk and uncertainty that are difficult to predict. I now hand the conference over to Mr. Raghunandana Tangirala, respected MD. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and a warm welcome. Joining me today on this call is Radha Ramanujam, our CFO, Amitabh Jaipuria, our Non-Executive Director, and Snehashish Bhattacharjee, our CEO of BSS. And also we have our investor relations team on this call. I trust you've all received the investor's deck, and it's also available on our website if you don't have it, and on the stock exchange portal. Let me begin with the Q1 high-level numbers. During Q1 26, revenue stood at 7,053 million, and we witnessed a growth of about 7% year-on-year. EBITDA stood at 444 million with EBITDA margins of 6.3%. PAT stood at 290 million and witnessed a growth of 13% year-on-year. So let me share first the industry update generally. Then I will come to IFM segment and the BSS segment. Global uncertainties, including rising tariffs, geopolitical instability, and macroeconomic volatility, have impacted our business marginally in some and slightly a little more in some, where technically their businesses are dependent on where there is a kind of dependence on foreign trade and especially in IT. This has resulted a slowdown in the discretionary budget across the sector. As a result, we are witnessing some impact on overall business momentum, especially in segments directly linked to global client engagement or global client spending. These global uncertainties have also weighed heavily on the IT sector, leading to budget rationalization and reduced headcount.
Operator request has been initiated. If you'd like to cancel this request, please press star 0 again.
Yes, sir, please continue.
Yeah, leading to reduced headcount addition, further dampening IT hiring activity and impacting demand for associated services like employee background verification. Despite these headwinds, UDS remains focused on driving operational efficiency, deepening client engagement, and expanding its value-added services. Our diversified business model across IFM staffing, background verification, sales enablement provides resilience against sector-specific slowdown. In addition, our continued investment in the digital platforms and automation is helping us unlock productivity gains, enhance service delivery, and position ourselves as a strategic partner to our clients. We believe these trends will enable us to weather short-term challenges and sustain long-term growth. Now I'll come to the IFM segment. During this quarter, we added 5 logos, which are large and marquee. Our headcount stood at 73,000 employees, which we grew by about 9% year-on-year. Our people are the heart of our operations, and we continue to invest in training, safety, upskilling them. We also have strengthened employee engagement programs and are focused on creating a supportive work environment across sites. In Q1 FY26, our IFM business recorded a 10% year-on-year revenue growth to 4,679 million, while overall growth was as per our business plan in the IFM segment. It's slightly lower compared to last quarter due to seasonality in our catering business, which is primarily services schools and education institutions, which have been shut down due to the vacation period. And year-end incentive claims on customers, which will come back next year in the last quarter. We also witnessed a modest slowdown in spending by some non-industrial clients. Despite these challenges, we maintained our growth momentum, underscoring the strength and resilience of our core operations. On the margin front, we reported a largely flat performance this quarter, primarily due to one-off provisions made for aged receivables due to delay in payments. Excluding this one-off, our IFM margins would have been higher than the same period last year. We took some expense on account of mergers of certain entities within the UDS. While it has benefited us from the tax angle, EBITDA stood at 258 million, reflecting a year-on-year growth of 8%. Our strategy in this segment remains focused on scaling profitability with an increased emphasis on high-value, technically intensive and system-critical contracts. Our leadership in the industrial IFM space is driven by our proven ability to execute complex mandates while consistently meeting clients' expectations. Looking ahead, we are targeting between 13 to 15% revenue growth in the IFM segment, with profitability expected to grow at a faster pace, supported by improvements in operating margins. This is further supported by several industrial tailwinds, including increased GCC investment and the demand for global standard IFM, manufacturing growth under Make in India, surge in e-com, logistics, and warehouse needs. According to Motor Intelligence, India's outsourced IFM market is set to grow at about 11% CAGR from 41,470 crores to 67,000 crores by 2029. Our focus will remain on ROCE accretive contracts that enhance margins and value creation. I would now like to share an update on Global, Avon, and our other BSS subsidiaries. Global continues to maintain its double-digit growth while staying EBITDA positive. In FY26, we expected much better turnaround in EBITDA and PAT, while in FY25 itself they had broken even. This is driven by gradual increase in travel volumes across domestic markets. We've also, our Global School of Aviation has also witnessed a stable increase in demand and is expected to continue meaningfully in the upcoming quarters. With rise in demand and outsourced aviation training, we see high growth opportunity ahead, and we are well positioned to lead in this space. We opened our second aviation school in Pune during this quarter, and this is seeing good traction. I'm also thrilled that Avon, our logistics solution business, has made strong strides in expanding into transport distribution logistics and integrated service solutions. These additions enhance our value proposition and deepen client engagement. Avon continues to witness a margin improvement driven by better sales mix, higher margin contracts. The company has commenced fast-track road logistics operations, which would further support margin expansion. Avon is also actively exploring opportunities in corporate relocation space, which could become meaningful growth revenue going forward. Now, I'd like to hand over this call to Snehashish Bhattacharjee, our CEO of BSS, to speak on the BSS segment of Avon, the Dene, Matrix, and Athena. Over to you, Sneh.
Thank you, Raghu. Good morning, everyone. Our BSS segment revenues stood at 2,374 million. I would like to give you an update on each BSS segment separately to give a better understanding of what drove Q1 FY26 performance. Let me start with an update on our sales enablement business, starting with Decode. While Q1 FY26 presented its share of challenges, we continue to see meaningful opportunities emerge amidst this evolving environment. Global uncertainties have led to more cautious corporate spending, particularly in demand generation services, with large global companies scaling back their marketing investments. We've seen a moderation in international delivery driven by automation-led efficiency models and heightened ROI expectations from clients. However, it's important to note that strategic high ROI investments continue, indicating a shift towards selective spending rather than across-the-board cuts. I'm also happy to share that we are currently in the ramp-up phase of IntelliBand for a large tech MNC customer, and successful execution here will serve as a strong proof of value, opening doors to similar opportunities with other large corporates. We are quite confident of a successful execution on this front. We have also started pitching IntelliBand with several other marquee clients in the technology space, some of the world's largest software and hardware companies, as well as a few new age AI platform companies. We are also leveraging the sales intelligence methodology used by IntelliBand to pilot the use of agentic AI and advanced outreach platforms such as Clay and Smart Leads, aimed at building a new automated campaign methodology for demand generation. By combining sales intelligence and AI-enabled digital outreach automation, the initiative is designed to enhance targeting, boost productivity, and improve conversion accuracy. Early experiments with select clients are underway, and we expect this to have a meaningful impact on revenue generation over the coming quarters. A few clients we onboarded during the quarter include SAP for digital and demand generation, Palo Alto, and Amazon Ecom, which are large potential clients. We also renewed key clients such as Shell and Tatacom, which further strengthened our base. Lastly, I'd like to highlight that despite the ongoing challenges in the business environment, we at Decode remain focused on what's within our control. We are continuously investing in technology, seeing strong traction from our core offerings for key customers, and staying ahead of the curve by driving innovation and execution excellence. Now I'll move on to Athena. As indicated earlier, few of our key customers insourced a portion of its activities, which impacted both revenue and margins for the quarter. Given that Athena contributes a significant share of our profits due to its high margin nature, this impacted overall BSS profitability. On a positive note, we continued to build momentum with new client additions during the quarter, including marquee names such as Lodha and Bajaj Electricals. We're also experimenting implementation of AI-powered chatbots for a key customer, which is expected to enhance overall efficiency and support our ability to maintain competitive pricing. The proof of concept rollout is planned for the upcoming months, and a successful implementation could pave the way for broader client adoption going forward. Lastly, we are confident that Athena's revenue run rate will normalize over the coming quarters, driven by increased contribution from both new and existing clients. Now moving on to the EBGC and audits and assurance business of Matrix. First, I would like to give an update on our fast-growing audits and assurance business. The growth prospects of this business continue to remain very exciting. Despite the pricing environment being competitive, we are witnessing strong interest from multiple large corporates. We are currently above the curve as customers are now focusing on high technology-enabled partners where we are at the forefront. We are confident about the long-term potential of this business, especially as we shift from execution-based contracts to value-led engagements that help customers optimize inventory and improve ROI. Our focus going forward will be twofold. First, to build deep domain expertise across sectors like apparel, retail, and FMCG, where inventory complexity is high and optimization is critical. And second, to improve margins in this business, a goal we are firmly on track to achieve. Moving to the EBGC business, the environment remains challenging due to significant spending cuts by IT companies amid an uncertain demand outlook. Large-scale layoffs across major Indian and global IT firms have further impacted hiring activity. Additionally, a few large MNC customers have temporarily frozen hiring due to internal IT infrastructure constraints. We're also seeing a broader slowdown in recruitment across other formal sectors. While the external environment remains beyond our control, we are focused on strengthening our technology platforms to enhance data security and deliver faster, more reliable employee background checks. We continue to lead the EBGC industry in turnaround times, reinforcing our position as a trusted partner for our clients. During Q1 FY26, the BSS segment contributed 34% to revenues, EBITDA stood at 186 million, and EBITDA margins of the BSS segment stood at 7.8%. On the way forward for the BSS segment, the overall business support services is aimed to grow at 15% CAGR, and India stands to gain, especially from the current economic scenario with impacts from GCC schemes, PLI schemes, and employment generation incentives for companies. Key drivers of this growth will be sales enablement, A&A, EBGC, and mailroom management. Now, I would like to hand the call back to Raghu to summarize the Q1 performance and expectation going forward. Thank you. Raghu, over to you.
Yeah, thank you, Ashish. Okay, to summarize, UDL has entered FY26 with a strong momentum and a focused strategic direction. And in the IFM segment, we have completed the rationalization of our contracts and now are concentrating on streamlining operations, improving margins, and capitalizing on the growing demand for technically intensive outsourced facilities management services. In the BSS segment, we are seeing the benefits of tighter leadership alignment, a shift towards high-margin technology offerings, and improved cross-selling opportunities across our platform. Our strategy going forward is anchored on profitability growth, capital efficiency, and a disciplined focus on the return on capital employed. We remain confident in our ability to deliver sustained value to all our stakeholders in the years to come. Now I want to hand it over to Radha Ramanujam, our CFO, to give a brief on the financial numbers. Over to you, Radha.
Good morning, everyone. For the updates from Raghu and Ashish, I would now like to touch upon the financial highlights for Q1 FY26. Total revenue from operations grew by 7% year-on-year to 7,053 million. The IFM segment revenue grew by 10% year-on-year to 4,679 million, while BSS segment revenues remain broadly stable at 2,374 million in Q1 FY26. Revenue split between IFM and BSS segments stood at 66% and 34%. EBITDA for Q1 FY26 stood at 444 million. EBITDA margins at 6.3%. IFM EBITDA margin was 5.5%, while BSS segment EBITDA margin was 7.8%. And EBITDA excluding finance income stood at 404 million, while IFM segment excluding finance income was 5.2%, BSS segment excluding finance income was 7%. Our consolidated EBITDA margin excluding finance income stood at 5.8%. Profit after tax witnessed a growth of 13% and stood at 290 million. Earnings per share grew by 13% year-on-year to 4.4 per share, and our ROC stood at 17.9%. Quarter on quarter, we are cash positive, and UDS net debt to equity stood at negative 0.2x as on 30th June 2025. Our headcount in IFM stood at 56,900 employees, and headcount at BSS segment stood at 16,200 employees. Overall, 9% growth. And during Q1 FY26, we added 5 new logos in IFM segment and 9 new logos in BSS segment. With this, I open the floor for question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Deep Shah from B&K Securities. Please go ahead.
Yeah, hi, good morning. Thanks for the opportunity. Sir, the first question would be on BSS, specifically Athena. So in 4Q, if I remember correctly, we had said that had chosen to move few processes in-house, amongst other things, for the weak numbers. And this quarter again, we've said that certain clients transitioned previously outsourced operations in-house. Are you referring to different clients here? Is it the same client? And so what is happening here? Some color would be very useful.
Can I take the question?
Yeah, you can.
Yes, please go ahead.
Okay. Compared to last quarter, the same client, moved their Bangalore business in-house. Of course, they are retaining their Mumbai business with us. They are doing certain cost rationalization, and that has moved out from us. So no new clients are moving out. It is the existing client.
So right. So then would it be fair to say that sequentially things have not become worse, right? Sequentially numbers. Also, if you could actually share segmental numbers, because I think BSS is a set of companies which have very different levers. It's very difficult to understand how his business is doing with a single number. So would it be possible to share company-wise numbers? Because that will make analysis much better.
Yes, we will share the individual company-wise analysis numbers. And compared to last year, Athena has not dropped much. Okay.
Yeah, no, I was only adding to that, Radha, to say that there are three large companies within BSS. We'll share those numbers with you, which is really Decode, Matrix, and Athena. And to what was said on Athena, the good aspects about Athena are also that there are 2-3 customers who have grown substantially with us. So one in the financial services space, one in the non-financial services space. So there are also customers who are growing up quite a lot. In fact, very strong double-digit growth with certain customers. In fact, certain large customers. So therefore, it's a slightly uneven picture. As far as risk mitigation is concerned, we are aggressively looking at diversifying, which is what I had specifically mentioned in the last call also, that we are diversifying away from our heavy concentration on BFSI customers into non-BFSI customers. And that we are seeing quite good momentum on that, including good wins. So therefore, we do expect that with our own adoption of more and more technology and with diversification of the customer base, we should be seeing Athena revenues not only stabilize but to start growing.
Yeah, right. This is super useful. Also, so would it then be fair to say that the reduction in operating profitability that we are seeing on the BSS side from 23 crores to 16.5 crores is to do with Athena, largely to do with Athena? Would that be a fair conclusion?
No, so what has happened this year is that there are, each of the 3 companies has faced a different set of challenges. And Snehashish, my colleague, he already gave some commentary around that. I'll just add a little, and then Sneha, please jump in and add more as you see fit. So Athena, we have already talked about it, right? So there was a shift within some of our larger BFSI customers into moving things in-house, and of course in 2 of them, as we had guided last call as well. In terms of the business having dropped substantially, in fact become close to zero, because of corporate action on their own side. So therefore, that is as far as Athena's contribution to the negative margin, to the negative growth is concerned. The other part of the business in terms of Matrix, as you all know, Matrix has two basic parts to it. One is the employee background verification, and second is the audit and assurance business. The good part is that audit and assurance is growing very strongly. So, and that is something which we had been, working on for quite a few past quarters, and that is beginning to show very good results. The unfortunate part in the Matrix business, which all of you also know, is the continued pain in the IT industry in this country. So, which we are clearly seeing. In fact, if somebody like TCS can lay off, people, then, that's really the bellwether, right? And therefore, that gives an indication of the pain that is happening in the IT industry. And that is impacting us very badly. So the EBGC business is continuing to face headwinds. In the last call, we had guided or we had mentioned that we believe that we have seen or we are close to seeing the end of that pain. But as is apparent now, that call was that we are not seeing the end of that pain. So that is as far as EBGC and Matrix is concerned. Dinave has a very different kind of challenge. There are some parts of the business that are growing very strongly, and the other parts of the business are basically facing headwinds, as Snehashish mentioned, because of geopolitical reasons and extreme caution in some businesses. We are seeing that spends are coming down. So, and there is this entire challenge around AI and uncertainty around technology, and therefore also caution, right? So, though in each of the three businesses, the challenges are different. Unfortunately, all three have come at the same time. And that is why you are seeing this slight downturn. But at the same time, what I want to emphasize for everybody on the call is that UDS's business model actually has stood the test of time. You can clearly see the fact that because of the mix of businesses that we have within IFM and within BSS and between IFM and BSS put together, we are still able to report good revenue growth in spite of these headwinds in some of our businesses. And we believe that as far as the year itself is concerned, even though the first quarter has been slightly, on the PAT side, we have still grown. I mean, we are at 29 crores versus almost 24 and a half crores similar quarter last year. So while we have grown on the PAT, we believe that the overall year still looks quite strong.
Okay, fine. This is useful. Second, on the IFM front, so I remember last quarter we had indicated that we had signed a couple of marquee clients, including Amazon. So the revenues, I guess, would have started to flow. We've seen 9% top line growth this year. What should be the steady state revenue growth that one should expect here? That is one. And subpart two, because of this deal, I think last quarter cash flows were poor. Has those cash flows come in? What would be a cash balance, say on 30th June? Thank you.
Yeah, thank you.
Radha, can you talk on the cash, please?
The cash remains slightly less compared to last quarter. That is also reflecting in our EBITDA. Like we said, some long delayed collection in a couple of clients. We have provided little more in the P&L. There's a chances that we will reverse it. We may not reverse it all day. The cash is similar to as of 31st March with a marginal drop. We are at 250 crores now cash.
Okay. I'll just add to that. You think it's 250 crores of cash similar to what we had the last quarter. So on the IFM growth, Shah, because you asked that specific question, we are confident we'll maintain whatever we guided. We confident or we are definitely hopeful of doing a 13 to 15% growth on the IFM. Again, to add to that what Amitabh said, since we have a mix of different businesses, even though certain businesses are facing a little bit of challenges, I'm quite hopeful that we will deliver on an overall combined consolidated basis whatever numbers we guided. So that is the confidence. because of the business mix.
Right. Radha ma'am, if I could just follow up. So, what would be that provision amount, if it would help us understand that? Because I think last year we saw like an 88 crore change in working capital, which impeded our CFO. And now that the cash balance is same, could you help us with the provision amount?
The additional provision which we have created during the quarter combined all the entities around 6 crores. And again, last quarter when we said the working capital change is 88 crores, we should also appreciate we have grown the business by 300 crores. Not entire 88 crores is on account of delayed payment. Compared to FY24, FY25 witnessed a 300 crore improvement in top line, even assuming a 2 months. See, the normal credit period is 60 days for us. When our DSO is 70 days, even assuming a 60-day credit period, 50 crore rupees will have to be parked for the working capital. So what we missed out is 28-30 crore on account of collection. So it's not like 88 crore has been missed out.
No, absolutely. This is super useful. Thank you.
The situation remains the same. The collection couldn't come in the way we planned. Of course, we are hoping it's to come in now, but it didn't hit the account before June, so that had resulted in little additional provision due to the ECL calculations.
Perfect. No, this is super useful. Thank you so much and all the best.
Thank you.
Thank you. Our next question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah, hi, good morning. First, thank you for the incremental disclosures, excluding other income and all of that. That's pretty helpful. So I just wanted your thoughts on a couple of things. So one is on Athena. If you could just give us the revenue and margin year on year, Q on Q. Maybe I'll take that offline as well. That's not a problem. But to understand between, have we seen a drop in margins year on year for both Denave and Athena, or is it just Athena? And how sharp would that have been?
Radha, we want to take that?
Okay. See, Athena, the margin as a percentage is slightly dropped compared to last year when we did 23%. We are at 21% now. But again, you should appreciate that top line has substantially come down there for Athena. With the 37 crore of top line, and when it comes down to 28 crore, there are other fixed costs which need to get absorbed with the drop in top line. That is the reason, slight drop, 2% drop in EBITDA as a percentage. While they still maintain, upwards of 20% in terms of EBITDA for this quarter. Then there is a marginal drop in the margin percentage. Last year we had 5.7% and this year we had 5.2%. And again, due to the mix of business and timing related to incentive collections and other things. So the cause of worry for us is the high margin EBGC business has not picked up in Q1. That has created a little bit of a shortfall in margin as a percentage for Matrix, and primarily the Athena drop in top line has resulted in some over absorption of fixed costs with a lesser turnover.
Got it. Now on the Athena side, is the revenue headwind over with from the transition for the large client, or should we expect continued weakness for another quarter? So that's the first one. And is this loss of margin that we have seen? How should we think about it? Is it a permanent loss, or do you think this sort of gradually comes back, or it can be a quick comeback? How should we think about it?
So I think, let me just nuance that commentary a little bit. So margins, as Radha mentioned, in Athena are now at around 20% or thereabouts. I think from what we are seeing and from the growth of business in the non-BFSI sector also, I think these margins now largely should remain stable. So there might be a percentage or point here or there, but otherwise, we don't see a drastic drop. Will it come back to the 25, 26, 27% that we had earlier? The answer is probably a cautious no. So I don't think we are seeing margins come back to that level anytime soon. So the way in which margins will come back is with our own adaptation of AI and technology platforms that can slash costs dramatically. We are experimenting with those, but at this point in time, it's too early to say whether they will contribute to the fact that the margins come back to what they were. So I think we should expect that this is probably the new normal as far as Athena margins are concerned. Revenue should come back, revenue should grow, is our belief.
Okay. But you don't expect, it's fair to assume no incremental revenue headwind in the following quarters. Well, it's largely done in terms of whatever had to shift out.
That is what we believe. But Ms. Neha, would you like to add any further on that?
Yeah. So just to add to that, thanks, Amitabh. See, at this point of time, it looks like we've reached the bottom on that. However, like we said, it's a dynamic situation and we can't hold on to that. But our present internal view is we don't see that headwind in the next 2 quarters at least, unless there is some drastic change that happens in the BFSI segment. At this point of time, we don't expect that to happen.
Yeah.
Got it. And the other thing was from a Decode perspective, how much of the deceleration that we are seeing is because of the macro, and how much of it do you believe is because people are maybe adopting AI, insourcing or whatever? Which is a bigger headwind to you at the moment? If I understand it obviously will be macro, but how big is the AI headwind? And do you think that growth overall we should assume at a lower clip going forward for for the sales enablement business overall?
Sure. Amitabh, I'll take that.
Yes, please. Thank you.
Yeah. So the headwinds that we talked about, and that is essentially both geopolitical and AI disruption, I consider both of them to be macro because actually if you look around, if you look at your probably other organizations that you interact with, this is a reality that is yet to be understood by everyone. Every company is trying to figure out how this will help them optimize or improve their productivity. So I expect that situation to continue at least for another 1.5 years. The last year was more of experimentation. This year, most companies are looking at implementation to see whether the experiment works. And if that works, year after, probably it will settle down. However, with the AI technology also getting advanced on almost a quarterly basis now, there will be changes that will keep on continuously coming up. However, at Decode, we also look at this as an opportunity. We are in the business of enabling sales, and the AI disruption that is happening is also enhancing the ability to both target as well as improve conversion. So while we do see the next 2 quarters playing out in a similar manner because customers have to see use case working for them to implement, but we at the same time also see some early signals of customers realigning with us on some of the new methodologies, and we've talked about them in the speech already. A couple of these customers who have renewed their contracts from a quarterly contract to a 3-year contract are people who are seeing that benefit. However, there is much more play that is to come in that space. Right now, we are probably seeing early conversion benefits, early productivity benefits. That needs to move up to a much more exponential level with the changes that are happening. So I am still being cautious. The margin is still going to be squeezed because the investments are going to be continuous at this point of time. We do see this turning around in the next 3 to 4 quarters as per me.
Okay. So I think your top customer is the most tech-savvy customer that you'll have. Is that a bigger headwind for you at the moment, and you're looking to sort of diversify from there? Is that what it is?
Okay. You're referring to our top customers in Microsoft, in this case, I'm assuming, right?
Correct.
Yes. So the top customer, if you see, almost about 60% of our revenues are coming in from the tech space. And each one of them have their own offering from an AI platform or AI tool perspective. Where we are coming in is leveraging of the same technology that they sell to help improve productivity and output. At this point of time, every one of them is continuing to invest in us. What has changed in some of these cases is their own definition of the outcome that they expect are changing, and which is where we are readjusting ourselves. Otherwise, at this point of time, the outlook doesn't look like them becoming a headwind for us. Neither Microsoft nor any of the other guys. In fact, in Telebank, we are working with one of the same largest software organizations where they have their own offerings, but we are still working with them and helping them improve their own sales outreach as well as conversion. So no, I don't see that as a headwind yet.
Got it. So in summary, I think from what you're saying, I'm done. I'm done. In summary, the next we should assume flattish revenues for the next 2 quarters on a sequential basis. That's a fair assumption to make. Is my understanding.
Flattish on not overall flattish at all.
This thing, what do you call sales enablement?
Yes. So, but with a upward bias, I would think. Yeah.
Got it. Thank you, and all the best.
Thank you. A request to all participants: please restrict your questions to two questions per participant. Our next question is from the line of Rahul Kumar from Vakaria. Please go ahead.
Yeah, hi. So just one question on this logistic business. Am I right that this business has declined sharply this quarter?
No, I would say the business has not declined sharply this quarter. Compared to the last quarter where we did 24 crore, this quarter they have done 26 crore, so it has increased.
Okay, because I'm getting numbers wrong from the presentation. That case.
Where is that you're getting it? Compared to Q4, there is a marginal decline. Q4 we did 28 crore, which has come to 26 crore, but against last year Q1, the business has grown.
No, I mean this quarter you have shown that the logistic is 4% of the BSS business, which makes it 10 crores, which is why I was asking.
Where are we saying that?
Where have we? That's what even I'm wondering. We generally don't quantify. Where have you seen this?
Sorry, this is in the segment-wise highlight of BSS, where it is written 4.2% is the warehouse management and niche logistics solutions.
You're talking about the pie chart.
Okay. That 4% of BSS.
It's okay. I'll take this offline.
Yeah.
The second question which I have was, if you just summarize, if you take this Q1 EBITDA as a base, what more headwinds are left to be absorbed in the next 2 quarters, either in the BSS or IFM? And are there any growth avenues which can offset these headwinds?
So I think the answers to the previous 2 or 3 questions I've actually dwelt a little bit on this already. So I'll just very quickly summarize. The headwinds that we are clearly seeing are because of the geopolitical issues. we are seeing caution as far as customer spending is concerned. That's the reality. India-specific IT headwinds continue. I think all of you are very well aware of those headwinds. And therefore, the EBGC business and to an extent some of the others will continue to be impacted, which is also a headwind that we have talked about. There are business-specific headwinds, such as in Athena that we have talked about because of our customers undergoing a little bit of change in their own strategy. The mitigants of how are we going to take care of these is also to some extent indicated in our own results. So, aggressively looking for new customers and new avenues of growth. In Athena, we mentioned about the fact that we are diversifying away from BFSI into non-BFSI customers. And we also mentioned about the fact that 2 or 3 customers, large customers, are actually growing very strong double digit, right? So growing existing customers selectively and looking at the non-declining parts of the economy or of the industry segments where we can grow. That is really one big part of what we are trying to do in terms of mitigating it. And even though that might sound very non-glamorous, but the fact of the matter is that those are the strategies that work the best. So aggressively looking for new customers, aggressively growing existing customers selectively wherever possible. The third area which we are working on very strongly for revenue, for the overall profitability growth is on the cost side. So, and we are already seeing actions around that across BSS and across IFM. And that will, at the end of the day, also contribute to our profitability. So overall, profitability this year will be strong. There will be a strong growth over last year. And if you compare business to business, because last year we ended at 119 crores, and out of that we had already talked about the fact that 10 crores was in a way non-business. So the business delivered 109 crores of PAT. This year we are already looking of very strong growth on that number. So that continues because of these 3 aspects that we talked about.
Yeah, okay. I'm just adding to what you said, Amitabh. I think the question was how does it look for the next 2-3 quarters for this year? Like what we guided, we said we'll grow at around 15% both technically in the EBITDA and PAT level. We strongly believe we will do that. We were talking in the last call, what will be end the year? We said the growth would be in the region about 15%. That will still remain because of the business mix.
Okay. Thank you.
Thank you. Our next question is from the line of Pritesh from Lucky. Please go ahead.
Sir, just listening from your comments. So, when you are calling out this geopolitical link to IT, ITS, and let's say BSS as our impacted area of business. So now I'm just trying to wonder, that's like 30% of our total revenue is BSS, and within that 30% contribution comes from IT, ITS. So we are like trying to do a conversation on 10% of the total revenue. On the impact side, there's another 90% of the piece in which IFM is like 75% of your revenue or 65% of your revenue, where you're hinting initially we're talking about growing faster than the industry growth, at least 2x the industry growth. Can you share some comments on the 90% of the piece of the business in terms of the trajectory of growth? And why is it that, we've been listening to you for the past 4 quarters. You have a stated growth of 2x in IFM, but what we see is half that number, so we are seeing 10% growth. So maybe you want to give some thoughts there and guide us properly.
So this 2x of industry is not, I think there is some miscommunication. I don't think we've ever said 2x of industry.
So that was another number of 3x GDP. So that's like some 20% growth also, right?
And yes, that is absolutely correct. We had talked about 3x of GDP. And over the last 2 calls, if you remember, because of the headwinds that we were seeing, we had talked about the fact that we'll probably end up between 2 to 3 times of GDP. And if you look at a GDP number today, most people are talking about 6.2% or thereabouts. And if you look at 2.5 times that, that is 15%. And Raghu just mentioned, as you will recall, that we will probably end up growing somewhere in that region in terms of both revenue and even more strongly in terms of PAT.
Pritesh, I don't think we've gone very wrongly there. I was maintaining always a 15% growth, which is what I said just now, because in spite of all these macro and the headwinds and all that, because of the business mix of having IFM and the BSS, we still maintain that. I don't think we've gone very much away there.
Yeah.
So if we split the two pieces, you are calling out that IFM will grow at whatever your stated objective is. And within BSS, what portion of the BSS business is impacted, if you could just quantify that?
Radha, you want to take that? What portion of the BSS is impacted? If we can combine all the BSS numbers, first quarter of last year to this year, and fourth quarter to this first quarter also.
Yeah, when we take out the little manpower-oriented business of Decode and the global and A1 out of the BSS, which is getting impacted, close to 45% of the BSS top line, when we have 240 crore of BSS top line, 40% of it is impacted due to this global changes.
Madam, you are not clearly audible.
Hello? Is my voice audible now? Am I audible now?
Yeah, maybe more.
Yes,
Yeah, you may want to reiterate.
Okay. See, out of my BSS business of 238 crore, if we remove A1 and global to be having a different challenges, the rest of the business, if I still remove the manpower-oriented business of Decode, close to 100 crore of a business is impacted by the global change in headwinds.
So basically, I calculated 10%, you calculated 100 divided by 700, that's 15% of the business is impacted, and 85% of the business is still, you guys believe that you will grow, right? That's how we should interpret?
Yep.
Yes.
Okay. Now, in this 15% of the business, do you see a downside? Do you see the business shaving off by some percentage, or you see the business continuing the way it is?
We have already answered that question when we looked at that overall Athena business. So Snehashish, my colleague, talked about the fact that we believe that we are now at a stage where further downsides will be limited.
Okay. Thank you.
Yeah.
Thank you. Our next question is from the line of Prince Chaudhary from Pink Wealth. Please go ahead.
Hello.
Yes, sir.
Yes.
Yeah. And so my question is that, in the IFM segment, basically, we have seen that, whatever the new contracts have been signed in the recent, last 6 months or 1 year, we have been seeing a good uptake in pricing, and those contracts are basically, for 2 to 3 years. So my question is that, in the long run, if we see after 3 years, if I have to see that outsource industry, do you see any structural changes that, that the shift from unorganized to organized will happen, and still the pricing which benefits have got this 3-year contracts, whatever we have signed recently, it will be continuous, there will be more cyclic, or there will be still cyclicality due to intense competition?
See, if you really look at the overall secular movement of formalization should continue, outsourcing should continue, and overall more and more compliance should continue. However, what we saw over the last 3-4 quarters on a business like Athena, in some cases, customers have reversed the outsourcing trend and have taken operations back in-house. Now, they may have done that for different reasons, but we did see that. So therefore, while earlier, a year and a half, 2 years ago, there was absolutely no stopping the movement towards outsourcing, Now it is a slightly more nuanced picture in certain industry segments, especially BFSI. So that is the only caution that we would like to talk about in our commentary to answer your question.
Yeah, just to add to that, Amitabh, I think he was asking on the IFM segment.
Yeah.
To answer that, I don't see there is any insourcing happening here. And what you asked was 3 years contract. Yes, we signed between 2 years, 3 years, 5 years, depending on the type of contract. So I don't see any changes there or any kind of something which is negative for us.
So my question was that, that during the COVID phase, we faced an immense, competition. That is why, the contracts were being signed at a lower prices. Then after that, the pricing environment improved and the competition intensity came down. So, but if let's say today, 3 years we are secured, but, I just wanted to understand that, is there any cyclicality in terms of pricing when we renew the contract due to competition?
No, there isn't.
No, we don't have that.
Okay.
There is no cyclicality in terms of pricing.
Okay. And do we see any structural changes, where we can say this IFM business will continue to grow at a, reasonable pricing contract? Because shift from unorganized to organized and lot of outsource?
No. We have always talked about the fact that pricing power in this business is limited and that it's a game for big boys in terms of economies of scale. And that is where our advantages lie as UDS, because we are amongst the largest players out there. So therefore, we have never said that we will pull price in IFM, because it's a competitive industry, and every day with every contract, we have to win our right to succeed, which we do. And that is why we have been around for 35 years plus, right? And that is why we continue to win new customers and continue to get our contracts renewed. So we will continue to do that. But will price change upwards in any significant manner over the next year or two? We don't see that.
And sir, downward, like, do we see again, like, if we see any shift competition intensity from unorganized, basically this IFM as a business is itself too difficult to scale. So just wanted to have your thoughts regarding that. Even if we don't improve the pricing, but those pricing contracts will be stable, or like then we're going to see a cyclicality like what happened in last 3 to 4 years past?
No, so the IFM margins industry-wide are around, depending on which company you're looking at, is between 4.5% to 6%. Right? It's not more than that. So therefore, our current view is that it will remain in this range.
Okay. Thank you, sir.
Thank you. Our next follow-up question is from the line of Nitin Padmanabhan from Investec. Please go ahead. Nitin,
Yeah, hi. Thank you for the opportunity. Yeah. Sir, you were suggesting 15% growth. Was that on an overall basis, or you were referring to IFM specifically? Just a clarification.
No, it's an overall basis.
Yeah. So, see, here's, if you could just help me with this math. So, when I look at, when we got into, for this year, when I just analyzed the first quarter revenue, I get an implied 2% growth over last year's revenue. Right? Last year when we entered, we had when we analyzed the first quarter, we had a 7% growth for the full year. Right? Now, considering that last year growth was around 12.5% overall, how can this year be better if our first quarter annualized itself is so meaningfully lower? Are we expecting a full pick up in IFM? Because at least looks like BSS is going to be sort of flattish over the next 2 quarters, more or less. Then how will that 15% growth be achieved? Shouldn't it be lower growth than last year on an overall basis? Is at least what the math is suggesting. So just wanted your thoughts on what we are missing.
Okay. I didn't look at that math thing. We have looked at what are we projected the next 3 quarters or for the full year. So you are right, IFM growth will be much more significant than the BSS growth, because BSS growth will still grow, but it won't grow like what we had actually planned. I think overall we'll still make up at the bottom line at 15% growth at the PAT level, EBITDA level. Even at the revenue level, I think we may not do 15, we'll do 13%. But as Amitabh was saying, this is all, especially in the IFM, it's how I manage efficiency. So overall, we are confident that is what we will do. But I'm not very clear on that 2% growth last quarter to this quarter. I would like to get into that to understand why that could be some aberration here there. But I'm clear on the plan, what we have got, or the business pipeline, and what contracts we have signed for the next quarter, because we don't have visibility for 4 quarters. We have at least 1 quarter visibility, so we know what will be the second quarter, or at least almost the third quarter. So that we are quite confident. In terms of the percentage growth, what you said, we guided around 15%, there's not much difference there. Even top line, Radha, what was the top line growth was, we had actually guided, but we need not be committed to that number. I remember it was 3,200 crores.
Yeah. So, Raghu, if I can just add without, sort of really getting into the weeds. So your math that you've done in terms of, you're basically asking what is the asking rate for the next 3 quarters in terms of where you're going to land up, right? And I think that's a valid question. We have done a lot of our own projections in terms of what we need to do in terms of quarter 2, 3, and 4 to be close to what we are talking about. On the earnings side, we are absolutely confident that the number that we have talked about will happen. Right. As far as revenue is concerned, IFM revenue growth, we know where we are going, and it will be double digit. We are quite confident. BSS, yes, you are right. It is slightly flattish. There is a certain view that some of these businesses, especially in part of Dineve's business, the A&A business of Matrix, and some parts of Avon's business, and some part of Global's business, right? That these and with the bottom having been reached as far as Athena is concerned. With these factors, the Q2, Q3, and Q4 numbers should be looking better. So is the current math. So whether it will be 15, whether it will be 14, whether it will be 13.5, whether it will be 15.5, slightly difficult to say at this stage. On the revenue side. On the net income side, which is on the PAT side, we are absolutely confident that the number that we have guided, very brief, broad numbers. This is not guidance as in formal guidance in terms of, how companies issue. We don't issue that. But whatever we have spoken about in terms of 15% plus growth as far as bottom line is concerned, we are confident.
Sure, sir. Thank you so much. All the very best.
Yeah.
Thank you. Ladies and gentlemen, this was the last question for today. I now hand the conference over to the management for closing comments. Thank you, and over to you, sir.
Yeah, thank you. Thank you everyone for joining on this call.
Thank you very much. Yeah, go ahead, Raghu. Sorry.
Yeah, thank you. I have been able to answer all the questions. We look forward to your such interactions in the future. In case you require any further details, you can contact Devan from SGA for our investor relations at right now.
Yeah, so, and just before we log off, Raghu, I do want to tell everybody very strongly that the company's fundamentals remain absolutely rock solid. And there's a management team that knows what it's doing, strong emphasis on governance and compliance, and very strong financial position of the company. So therefore, the platform remains intact. The issue of some macros impacting short-term quarterly numbers might be there and is there, but the long-term process of the company remain absolutely solid. So that's I just wanted to end by saying that.
Okay. Yes. So thank you all of you.
Thank you, everyone.
Thank you. On behalf of Updater Services Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.